Well, I'm really glad that we finally got Dave Witherspoon on camera. I know Dave's been on vacation, and unfortunately, Dave came down with an illness over our pre-recording of the panel discussion, so he was unable to actively participate in the panel. So we thought this would be a good way to get Dave's thoughts. And just so everybody knows, it wasn't COVID-related illness; it was just a run-of-the-mill illness that kept him out of the lineup for that day. So, Dave, welcome. Glad to have you with us.
Great. Thanks, Larry. It's nice to be here.
Why don't you give me a little bit of your background with KatzAbosch? Fill us in on, a little bit what your role there is, some of your credentials, and then we can go with some of the content.
Sure. I joined KatzAbosch just about 9 years ago now, and took over as the head of the valuation and litigation support practice. The overall firm, of course, KatzAbosch, is a 100-person CPA firm, regional, headquartered here in the Baltimore metropolitan area, but with offices in various locations around Maryland. The litigation and valuation practice that I run is primarily run out of our Timonium office, but we frankly do work all around the country. In various litigation scenarios. So we do everything from IP litigation. We're involved with some class action lawsuits right now on the economic damages side. Certainly work on a lot of shareholder disputes and of course marital dissolutions as well.
So you mentioned litigation a lot. You're not a lawyer.
I'm not a lawyer.
So what's your role? Give me some sense of what your role is in that litigation.
Yeah, absolutely. So typically we get brought in by the lawyers to testify as expert witnesses regarding the value of a business or the value of economic damages that one or more parties may have suffered in the complaint, in the litigation. So again, it typically is valuation centric or economic damages centric.
Well, terrific, because we're going to talk about valuation, so it sounds like you're we're in the right spot, right? We got the right guy on the phone, so to speak.
Absolutely, and I should point out also, Larry, that along with that work goes a fair amount of merger and acquisition consulting. So we work with parties on either side, buy side or sell side, and we'll help them either establish a value for a business, come up with negotiating points for why a business may be valued higher or lower than the counterparty is thinking, and we may help our clients, with those negotiations themselves. So we really take a pretty holistic approach to consulting around business value, and a lot of times that involves a lot of merger and acquisition activity.
Interesting. So your perspective is you don't have a dog in the fight. You'll take any dog in the fight, right? So
that's right.
Not to sound, crass, but the bottom line is you can represent any party involved in the litigation, to be more specific.
That's absolutely right. And we maintain our independence throughout. That's key to being a good expert witness, is that one has to maintain their independence and their perspective of independence from the trier of fact, or the judge in most cases. So,
yeah, I can only imagine some of the things that you've done and heard, and I'm sure your experience is pretty interesting. But to get to the topic, part of our panel discussion that day, the first one was really talking about more of a general idea of how has the pandemic impacted the issues that you're seeing involved in that litigation, involved in valuation. And we don't want to get too deep into valuation, because that'll be the next question, but give us a general idea of where you see the greatest impact as far as the pandemic has been.
Yeah, absolutely. And we've seen it really across the board. And like you said, we'll get into some of the specifics on valuation, but the reason that we get calls to be brought in to do evaluation in the first place, of course, have changed to some degree. Anytime there's massive changes in a regulatory or economic environment, we may see the demand for valuations from different perspectives. So in times of suppressed economic activity, we may see an acceleration in valuations for estate and gift tax purposes, because people want to be able to gift more with their lifetime exemption limit than they might otherwise be able to do in a booming economy. Litigation, of course, is always going to be there. Mergers and acquisitions, interestingly, of course, did take a hit in terms of total activity, but those companies that are still attractive, even in a COVID environment, are very attractive, and therefore market participants are still fairly active in looking at businesses, considering whether or not they should make an acquisition, or considering whether it's time to get out. And so there's been some consulting on considering whether or not it's time to exit the business. So those are some major issues. Of course, we keep speaking with our bankruptcy attorney friends who tell us the wave of bankruptcies and Chapter 11 work is coming, which of course requires a substantial amount of valuation work in it as well as regular financial advisory services. So we're hearing a lot of discussion in those areas. Candidly, I haven't seen as much of it as we thought we would at this point, but we do expect that wave is going to hit, probably over the next 12 months.
What's interesting, and recalling back on what we discussed at the panels, is, the theme was, and you verified that things kind of got paused for a little while, right? So there was a pause, there was a moment where everybody had to kind of catch their breath. And once people caught their breath, activity started again. Now the dynamics might have changed a little bit, but there's still a lot of activity out there in terms of transactions and the possibility of transactions. Maybe the players have changed a little bit, maybe the valuations have changed a little bit, but there's still a lot of activity. Is that true?
Absolutely. And the fact is, in a private equity space, in the venture capital space, there's still a lot of dry powder out there. There's a lot of cash available to make investments. The real question is, in a COVID environment, where does the smart money go? And moreover, if you think about private equity groups in a private equity fund, you may want to take a look at that fund's cash flow, and they may now want to hedge against a downside economy by putting some companies in that are still performing well on a cash flow basis, even in the COVID economy. So I agree that the target companies, the industries that are attractive, have probably changed, but those in the space are still very actively looking at deals in the right place.
So, again, reflecting on what you just said and thinking back, you mentioned the industry shifts, right? Where the businesses are that now people are looking at and moving away from some industries, moving into other industries. Can you talk a little bit about that?
Well, I mean, I think clearly technology companies, software-based companies that don't require, face-to-face interaction, those types of things are very attractive now. SaaS companies, software as a services companies, were already popular and already getting very high multiples. This type of environment is even more attractive potentially for them. On the downside, of course, you have the retail sector, which has been demolished. They continue to get hammered, but up to be seen yet whether or not they're able to recover once a vaccine comes out, or whether or not consumer habits have really just fully shifted. Sure. But you've seen a number of bankruptcies in those spaces, or in that space in the retail sector. But there are a number that are doing well. Professional services, interestingly enough, seem to be doing fairly well. Medical practices, obviously, for elective medical procedures, did get hit pretty hard. But regular professional services companies, I think, have done fairly well. And it'll be interesting to see how they progress moving forward. I think a lot of them are considering reductions in their overhead in terms of rental space for their staff. Some people are getting very comfortable with working from home, and that may have a negative trickle-down effect into commercial real estate. Sure. 6, 12, 18 months down the line. So this is one of those things that periodically happens in human history that may have a transformative effect in a number of industries over time.
The one industry that was mentioned, and you kind of touched on it, was restaurant and recreation, right?
Sure.
So those two industries just have been smashed.
Yeah.
And while they probably had their own challenges even before that, now it's the challenges in front of them are just enormous. Right?
That's right. And you can even get a little more nuanced than that. If you break down restaurants into white tablecloth sit down dining, they've been hit very hard. If you look at restaurants that are a little bit, we'll call them lower scale, lower dollar point, fast food companies, or even one-off shops. My favorite burger joint right here in Towson, Burger Brothers, they're great, and they have, I'm sure, had a negative impact, but they don't really rely as much on seating in the restaurant. People can just come in and call in their order, come in, pick up their burger and go, and they're making it. And so there really is a very serious bifurcation in the types of companies that are really hammered, even within an industry, versus those that are able to just maneuver their business operations a little bit to make it through.
So I should be able to continue to get my Big Mac at McDonald's. I don't have to worry too much.
I think McDonald's is going to be okay.
We'll be okay. It's fascinating. So let's move to valuation, because I know that's kind of I know that's your strength and what you spend a lot of time in.
Sure.
Let's talk, if you can just kind of, before we dig really into the weeds, give us an overview of what you think the impact of the pandemic was on valuation. If there are a couple of key elements of what moved in that valuation world.
There really are some pretty significant changes that have occurred. Maybe best to start with a quick primer on valuation. We typically look at a company through three lenses, what we call the income, the market, and a cost approach. On an income approach, we're really looking at the future cash flow generating capacity of the business. So this is revenue minus expenses minus other things that you have to do to reinvest in your business and capital expenditures. But what's the bottom line cash flow that's going to be available to the investors in the company? And what's the risk of achieving that cash flow? Okay. And on that income approach, we have two primary methods. One is just taking a look at the most recent year and capitalizing it or putting a multiple on it. That's a risk-adjusted multiple. Okay. So if we say cash flow that is available to the equity holders is $1 million, and we say that there's a 10 cap on that, then we would say the value of the business is a 10 times cash flow or a $10 million valuation on the equity of that business. That method of capitalizing cash flow presumes that future cash flows are stable at this $1 million level, okay, or steadily growing at a predictable rate. And that, in many cases, in a normal economy, may be the case for a lot of businesses. In the COVID economy, that really shifts, right? And we take a look at temporary severe downturns to financial performance for a given company, with an expected ultimate rebound of that performance at some point, hopefully to normal levels, okay? Or for some companies, it may be exactly opposite, an extreme upside because they happen to be, we'll call them COVID-proof type of companies. They may have a significant upside, but then they will expect to trend back down as their competitors are able to regain their footholds. Both of those types of scenarios really require the appraiser to look at a detailed financial forecast of that cash flow. What is the impact on that cash flow over time? And how long does it take to stabilize back to a new normal level? That method on the income approach is what we call a discounted cash flow model. And so from an appraiser's perspective, a very material change is where we may have just simply needed to ask for historical financials and use those historical financials to develop a capitalization of benefits method. Now we really need to work with management to develop a financial forecast and present value that future forecast back to today's value. It's a very distinctly different exercise for an appraiser to go through, particularly when financial forecasting is so difficult in this environment. So it really requires the appraiser to work with management very closely to understand the basis of financial forecasts and their reliability or perceived reliability. Okay, so that's the income approach. On the market approach, what we really do is we take a look at market multiples for similar transactions. So we may have publicly traded companies in this industry that trade at 1 times revenue or 5 times EBITDA. Okay, and we have typically looked at the market multiples for those in that industry, and then apply maybe some adjustments to the multiples if your company's smaller or more risky. But we want to basically use those multiples and apply them to your company's metrics. So if it's 1 times revenue and you have 5 million revenue, we might say your value is $5 million simply based on the market multiple. Well, in many instances, that market multiple applied to your last year's financials, if your last year was 2019, may be completely meaningless. Right. Moreover, if the multiple itself came from old transactions, let's say of privately traded companies, your industry may not be trading at 1 times revenue anymore. And so there's a lot of detailed analysis now that goes into market multiples and their application in the COVID world. And there are a number of people out there who question whether or not it can reasonably be applied at all in this type of environment, particularly for the private transaction market multiples. Now, the publicly traded companies may or may not be indicative of your company. And what we've really seen is a bifurcation of the impact of COVID on the public sector versus Main Street. If public companies are able to weather the storm, either because they have access to the debt capital markets or raising equity capital to survive the storm, their smaller business counterparts, even in the same industry, simply may not have that access, and they may not be able to weather the storm. So there could be some very, very severe differentials now in market multiples for public companies versus private companies. Okay.
Well,
the third,
just, as you're talking, what's interesting is it's kind of like, so here you are, I'm going to call you a content expert or an expert of a particular field. And you kind of, and I'm not saying this is you, but, you kind of go on all the old principles and you become really comfortable with, how the market works and how you value a company. And then all of a sudden COVID comes. And basically folks like you have to kind of throw all that out and not reinvent, but reconfigure how you view the market, right? And how those dynamics have changed. So it must be fascinating for you and interesting because it can't be boring, right? So
it's certainly
got to be, the ground is shifted under you and under the things that you do, as well your clients, obviously. And is that stimulating for you? Is that created new juice for you, so to speak?
It has, to a degree. And of course, I've always loved business valuation and data analytics and the type of work I do. It does make it enjoying. But one thing that I think is kind of interesting is I might take a little bit issue with the way you characterized it. Business valuation at its root has always been a forward-looking exercise. The value of a business today has always been the present value of future expectations, like we discussed in the discounted cash flow method. We simply use the capitalization of benefits method because it presumes future cash flows are going to be relatively in line with historic performance, right? It's sort of what you can call it a shortcut to a DCF if you want. In fact, mathematically, that's exactly what it is. So the exercise itself of thinking about what is the future cash flow generating capacity of this business, that has not changed. It's just become much more complicated because it's very difficult to project or predict how COVID is necessarily going to impact one business or one industry over the other right now.
So the variables that go into that formula are much more nebulous at this point. The formulas are basically the same. It's just what are we inputting? I mean, what's the information that's going to be inputted that's going to be help us accurately forecast, so to speak? So
that's right. And in the real M&A world, of course, risk is uncertainty. Risk drives down value by definition. And anytime there's uncertainty, i.e. more risk, then valuation is going to be suppressed. So the real trick to enhancing that value of that business is to reduce the uncertainty in any way you can. And in the world of COVID, that may take on different meanings. That may mean, in the case of a restaurant, doing curbside pickup, right? That may mean developing an app where you have traditionally sold your service in person. Maybe now you need to shift to a more online presence and be able to drive your sales and marketing through online presences. So any way you can reduce that risk and show the buyers out there that you have reduced the risk, you can increase your value.
Well, that kind of brings me to another theme that was running through our panel discussions and almost to the last segment of our chat, was the distribution of risk and how risk is being addressed in the transactions. Yeah. Are the buyers in the driver's seat now? Are the sellers kind of reeling a little bit and have to convince the buyers and mitigate the risk to the buyers more that they may have had to do previous to the COVID? So how does that look? How does that come to play in the transactions that you've witnessed or been part of litigation in? Give us some of that, and I think that really kind of addresses the last segment of what we want to talk about.
Yeah, no, it's a great question, and I'm quite certain our friends on the investment banking side, Mr. Maskell, and some of the other panelists probably had some very insightful things here to discuss. What I would say, what I've certainly noticed is that buyers are much more reticent to put cash down up front. They're much more interested in a larger portion of the purchase price being an earnout or some type of deferred payout, preferably an earnout from their perspective based on the future performance of the company that they bought. Those tools are really nothing more than a way to bridge the value gap between what the buyer thinks he or she is willing to pay for taking on this risk and what the seller thinks the company or the business is worth. So if the seller thinks it's worth $20 million and the buyer feels comfortable that a $10 million cash investment will give them the return, a guaranteed return that they demand, they may be willing to go up to $5 or $7 million earnout on top of that cash, so that if the business does perform, the buyer still gets their return on their investment, and the seller feels like they have a chance to actually get the value that they think the business is worth. In a really high, in a seller's market and a really tight seller's market, they can command a higher percentage of the transaction in cash. In a more uncertain environment, you just have to bend a little bit more and go a little bit more with the earnout. There are other, technical things that I know the lawyers can work with inside of the asset purchase agreement or the stock purchase agreement to spread a little bit of risk around as well. They're certainly more qualified than I am to talk about those things. But on the deal structuring side is where I typically see it and where I come into play. So
in that regard, and we talked a lot about the forms of transactions. So universally, everybody said ESOP was a non-starter. That's just, none of the panelists thought that was anything that had any value in the marketplace right now. Do you see a shift in terms of whether we're going more towards management sale or owners trying to get out? So they're going to try, well, I'll sell to my management, I'll sell to whoever. Is there a little bit of panic in the market for sellers? Give us a view of that.
Well, of course, everybody puts their best poker face on when it comes to merger and acquisition discussions. So, someone who does just want to get out, if they're savvy, they're masking that to the best of their ability. I agree. I think ESOPs are much more risky and therefore much less attractive right now for a number of reasons. the Department of Labor has been, aggressively pursuing folks in the ESOP space, fiduciaries in the ESOP space, when things go south. And of course, in down markets like this, that it can pose additional regulatory risk that is not necessarily attractive. And moreover, it may not be attractive, frankly, for the employees of a business right now to think in terms of investing in that business. So listen, we still see a fair amount of family-owned businesses transitioning to the next generation of family. Valuation is not, usually the biggest concern in that type of scenario, with the exception of preparing a gift tax return. I don't see as much management, buyout discussions right now, unless they really feel like the business has been hammered and it's going to recover, and they think they can get a business on the cheap and the owner wants out. I suspect those cases are out there, but I suspect managers are much more interested right now in just driving their businesses through this, as opposed to looking at a management buyout. Strategics are still in the market. If they got cash, if they got access to capital, and strategic players, cash flow positive industry players typically do. The capital markets are very open right now in terms of low interest rates on debt. And if they can make a good strategic acquisition, that's out there. And again, the private equity folks and venture capital folks have plenty of cash to be able to invest if the deal's right. So that's more along the lines of what we see now.
I want to thank you, Dave, again for giving us the opportunity to talk to you and add your expertise to what we have to offer. And I'm glad you're feeling better, and I hope all is well at KatzAbosch.
Thanks, Larry, so much for all your energy on this. I wish I could have been there with everybody at the panel, but I'm real glad we were able to connect to talk about this today.
Yeah, this is great also. So thank you, Dave.
Great. Thanks, Larry.